Let's go.
What's good, baby? It's your boy Dale.
I'm back in the saddle again. Our motto is to buy, build. We already bought it already, so we already own it, free and clear. Refinance to long-term debt, cash flow. That is the motto. Cliff, man, is that a pretty strong motto, man? What do you think?
Man, the model is strong. Like, you're getting each piece of the investment, right?
What it do, y'all? It's your partner Dale. You know what time it is. It's Friday. You know I look better than you. It's okay. Accept that reality. It is the standard. Don't get mad at me. Talk to your mama now. All right. Y'all, let's move forward. Today, guys, it's going to be me. Today, Cliff is actually a little bit under the weather. He's doing just fine. But be praying for him a little bit, y'all. He lost his voice and he didn't sound that well. So if you could, guys, pray for him. That he gets that healing, because he actually gonna need a little bit of it because he didn't sound too well. But that's okay. We're gonna hold the fort down today, guys. Today, guys, we're gonna dive right into something that is near and dear to me, is realistically how to plan the proper exit strategy with the rising cost of capital. But before we go there, let's dive right into the current market analysis, guys. You know how we do it every single week with the changing economy. You're going to have to understand and see exactly how the market is going. Well, me talking to professionals and licensed appraisers and inspectors, you name it, this is what we're getting. There's still a lot of pullback on the sales side. In other words, properties over a certain price point, over the $400,000 range, is normally still on the market a little longer than it normally would. Which is not uncommon at all with where the economy is at. And number two, refinances are damn near gone. And because the cost of capital, excuse me, has went up high. And so what's going on is you got to be able to make a pivot on this. So you're feeling this inflationary standpoint from a cost of capital side, because rates are going up, because the Fed is trying to curtail the excess spending that the government is doing. The problem with that is, unfortunately, the government is still spending more and more money. So the raising of the rate is not having the effect that it should have. And so would I be surprised if there's going to be a higher debt rate, higher interest rate raise, which is most likely what's going to happen as well, guys. So again, this strategy here that we're talking about right now, what's going to happen here is this strategy is going to help you guys as rates continue to climb. Okay, so let's jump right into it. That's our market analysis for today, guys. And if you could, whether you're on Instagram, if you're on LinkedIn, if you're on YouTube, you name it, Facebook, share this with 5 or 10 people. The reason why is these strategies can actually work whether you are on the investment side and also on the homestead side, but more so on the investment side. So let's get right to it. How to plan the proper exit strategy with the rising cost of capital. That's what we're going over today. Okay, and I won't be long at all. It's just going to get in. We're going to get out. Oh, my bad, y'all. Before we move forward, I got that bag. Y'all know I got that bag, boy. It's your partner, man. I'm always getting that bag, y'all. We actually graduated one of our larger investments over to long-term debt, and I'm gonna let you know exactly why I did that. It's because we're finished with the renovation process, and number two is we decided to go with an interest only long-term scenario because of a rental scenario. The reason why is because of the fact that as rates are increasing, we thought it would be wise to go with interest only because of the fact that we have enough cash flow coming in from a growth standpoint and a net growth standpoint to cover the debt service as well as taxes and insurance. This is on a big portfolio we actually have. And also we like what we call it the asset of debt because we're making more money than what we're paying out. We like the asset of debt because of the fact that we get those old-fashioned, we love those tax write-offs, baby. So that is kind of a two-edged sword. So make sure you understand how to manage it well. And hopefully this topic can help you understand how to manage it well. So let's go to it. The first strategy. A wholesale strategy. Some folks may not know what a wholesale strategy is. Wholesaling is very simple. All you do is you, as an investor, you get a property under contract, okay, for $100,000. And then what happens is you begin marketing that property that you now have under contract to a buyer that wants to buy it. And let's say you put a $5,000 assignment fee there. Okay. So you have it under contract for 100,000. You have a assignment fee of 5,000. It means you assign it over to this new buyer for a $5,000 fee. Now he's buying it at 105 plus closing costs. When the deal funds and close, you make $5,000 and you have little to no money in the deal, and your credit was not at all at risk at all because of the fact that it's just an assignment fee. Now, what a lot of wholesales would do is a lot of wholesales use really bad comparables. They'll get comparables guys that are 5-10 miles away. The specs of the home don't match the subject property, so you're gonna have to really be careful, understand how to pull comparables as far as value comparables and rental comparables. You want the as-is value and the ARV or after repair value. Okay, so as a wholesaler, what should you do? Well, you're going to probably have to look at, because the cost of capital is going up, LTV has to go down in order for LTV, meaning loan to value, has to go down because it's costing you more to get that debt. Okay, so that means you got to buy a property really more at a sale value. Okay, and I like buying properties below wholesale. So if you want to begin to still make a living wholesaling properties, which you still can, you have to probably get properties at a deeper discount. You can get that, but it's going to take probably a little bit more work. Okay, so what's the strategy when it comes to wholesale? Really get properties under contract at a deeper discount because it's costing the buyer more money on an interest rate standpoint, the cost of capital, okay, to get the debt to buy from you. That makes sense. So the numbers actually change. All right. So let's go to the second one. Now let's go to the flipping scenario. Flipping, very simple. You buy a property at 100, get a property under contract, and you buy it at 100 grand. You put about 20,000 into it, and then you sell it for 150. You made a $30,000 arbitrage there in profit. Okay, that's a flipping scenario. Okay, now flipping it's kind of the same strategy when it comes to a wholesaler. What I mean by that, in order for you to make your numbers work, you're going to have to buy it probably at a deeper discount because typically wholesalers are looking for flippers. Okay, they're looking for long-term holders as well, also. But typically, since they're buying a property, get a property on a contract that's really kind of in distress, because the more discount, the more distress it is, the more work has to be done. Typically, that's attractive to a flipper. Okay, so you may want to mimic that exact same strategy that a wholesaler actually has. You have to look at getting the property or at a deeper discount because it's costing you more money to get the debt to buy the property. You probably borrowing the debt to renovate the property. Okay. And then also you want to make sure you have enough arbitrage there to flip out of the deal and make your arbitrage, so whether it be a $10,000, $20,000, $30,000 flip, where it may be. Typically the sweet spot, in my opinion, is $400,000 as far as the value, ARV, after value, and below. If you go over 400,000, don't be surprised if you're holding on to the property for a long period of time. Okay, all right. The reason why that is important is because of the fact that, to me, the properties $400,000 and below have not really had an inflationary standpoint at all. So they're kind of at the bottom of the barrel when it comes to pricing. There could still be a little bit of a correction, a little bit, but you don't see a 30 to 40 to 50% correction, which is around the corner for those properties, $400,000 of over $400,000. If that makes some sense, guys. All right. Now, hold strategy. All right. What's a hold strategy? Very simple. You buy a property, you buy it and you renovate, increase the value, you refinance it to long-term debt. and then you hold it via you leasing the property out, or you sell or finance the property out. I'm gonna do a real estate live on seller financing. That's a little known strategy that very people actually implement. It's going to become very popular moving forward. Very popular. I would not be surprised if seller financing rates beat banking rates here soon. You don't believe me? Watch. But on the whole strategy, it's kind of the same, a little bit of a remnant of the flipping and wholesale standpoint, but typically hold investors are not really interested that much in a deep discount because they're looking at a long-term hold. So there's a time frame that they're looking at to get their money out. That time frame could be 12, 24 months, 36 months, or even 5 years. It really depends on how deep their pockets are or how they structured the transaction. Now, for me, now what do? I buy properties below wholesale. So when I buy properties below wholesale, I have very little of any money in the deal. No matter if I'm buying, flipping, I don't wholesale at all, typically, but I do a lot of holding. And so for me, since I get them at so much of a discount, uh, I'm basically generating an infinite return. And so for the hold strategy, it's very simple. You may want to look at still mimicking the wholesale and flipping strategy because the deeper the discount, the greater return for you. But most holders can stomach a higher price point than below wholesale. They'll buy wholesale, and some even a little bit over wholesale to get a property that they can see that's going to be attractive, that they'll get higher rates of return because the rents are increasing incrementally over a period of time, which is good for them as well. And also, they can also look at, okay, if all else fails, I can turn around and sell it retail, or I can sell a finance the property out to where I keep the asset on my balance sheet and I become the bank to somebody. I'm giving a little bit of a secret now. You better write this down. And then what happens is by doing it that way, uh, you can if your rate is, let's say your rate is 6.8%, that typically get a 6 to 7% rate, I believe, right now. And let's say, for instance, you can turn around and charge seller financing 9, 10, 11%. That's possible. I've done it several times, guys. Seller financing, 30-year term, people paying 10, 11% all day long. All day long. I anticipate, this is my opinion, because the government's printing so much money, I would not be surprised if the interest rates go over 10%. Then all of a sudden now there's a competition between seller financing notes and banks. So now there's a competition. I love competition. So again, just giving you what a flipper would do. Okay, a flipper can actually buy at a little higher price point because their framework, their thought process is more of a long term play. Okay, but that's it for that whole thing. Because I hope this helped you out at all. Oh yeah, guys, and man, we finished up that this real estate course, guys, is we went a little bit deeper than we normally would do because we wanted to really present value to you guys. We want to be different than anything on the market. Okay, to kind of give you kind of what's coming with the course is we're looking at even funding transactions with our own money if the deal makes some sense. Joint ventures as well. Also, you get educated also as well. So you get the wise counsel, the consulting as well. Okay, the debt, and a JV partner. So we can teach you how to go from 0 to 100 by starting a business, a side hustle, turning that into a verifiable business, scaling that business. Now it's an enterprise. It's real simple, guys. So, man, I hope this helped you guys out. I didn't want to be on here too long. Again, Cliff is doing just fine. He is just under the weather a little bit. He sounds pretty bad, but he's fine. Just be praying for him and his family because he does have a little baby girl and she loves her daddy. She loves her daddy, man. So I hope this helped you out, guys, a lot. I am going to post this video. I advise you guys to re-listen to this over again because as the market changes, which is changing on the dime all the time, and I expect for it to change again, and I believe for the worst, it's probably wise for you to understand how to balance out a higher interest rate, or a higher cost of capital. Good rule of thumb: the higher the rate, the lower LTV, loan to value. Okay. So if you're planning for a 75% graduation out of your short-term debt, it may be wise for you to plan for a 70 to 65%, because the rates are going high. Okay, they're going up high. Just giving you guys some game. But guys, thank you. Hey, Nikki, how you doing? Good to see Nikki from Instagram is here. How you doing? Doing just fine. Let's see. Any questions at all on here? Nope. So guys, I hope this helps you guys out. Well, the course is about 95% done, guys. Turning it into an app is hard to do, but I think we're going to issue the website initially first. We're also making promo videos for the real estate course as well. We're just trying to present to you guys value. Okay. But guys, thank you so much for your time. God bless you. And there's a video coming out for Gabby. Guys, real quick on the sidebar. Gabby, because of you guys, Gabriella, my daughter, who's a cheerleader at a high school, she was the #1 fundraiser for their campaign because of you guys. You guys did that. And there's a video coming out that she wanted to say thank you to everybody that they gave to her. She's enjoying it. I can tell she's tired. She's really tired because they're working her buns off. She's lifting weights for the first time. Praise the Lord. That's good. And so she's really getting used to being even more active. Okay. But guys, thank you so much for your time. God bless you. If you can't share this with about 5 or 10 people, because as the market changes, you better understand how to manage debt. Because as debt rises, the risk goes up. And a good rule of thumb is the higher the rate, that's when you begin to adjust the LTV. All right. So guys, thank you so much for your time. God bless you. Hey, Tennessee Conservative, how you doing? You doing all right, man? Good to see you guys again. But thank you guys for your time. I got to get off. And because there's a football game tonight with Gabby, and she's pretty excited about it, guys. So again, a video is coming out, and she really wants to thank you guys for all that you guys have done. She was just so excited and overwhelmed about the amount of support that she got. And so I said, man, that's my people. This is my folk. That's what we do. All right. So thank you guys for your time. God bless you. See you next time. Peace.
Okay.
Sir, there's a GC right there. Cliff.
Go. It's piers. We got concrete piers and wood piers.
Yes, sir.
Checklist. Check out the checklist. We
Yes,
got it for everything we need.
Yes, sir.
Right, you forget some things sometimes.
Mhm.
So this is going to outline, make sure you hit every single thing. What's the foundation, plumbing, electric, painting, flooring, everything. So you don't miss anything.
Okay.
You want to make sure you get all your checks.
Okay. I want to introduce you guys to Cliff Hunter. Cliff is a world-renowned flipper. He actually flips. He's also a GC as well. He's a good contractor. When it comes to all of our renovations, all over the nation, you'll talk to this guy right here. Yeah, you, real estate investor. Hey, let me ask you a quick question. How much money could you make if you had access to an unlimited amount of capital to acquire your real estate with no credit check, strictly asset-based financing, and quick closings? My name is Liddell Buggs, president of 316 Capital. We are a residential and commercial real estate finance company. Click on the link below or swipe up to have someone from our staff contact you to assist you in closing your next real estate transaction.